What is going on, everybody? Welcome to Bitcoin and Markets. Happy Friday out there. Hope you are doing well. So, I haven't been live streaming as regularly here on YouTube, but still doing the live streams regularly over on Telegram. You guys can check that out. Link is down below. Today, I wanted to go through a video request from one of the people in the Telegram, and we're going to talk about it. It's Hershey Financial. Let me bring that up. But before I do, guys, this is bitcoinandmarkets.com that you're seeing on the screen. Follow all the stuff I'm doing. A couple tiers worth of different content structure here. There is the free tier. I do put blog posts out like this one, Rethinking the Center of Gravity. That goes out free for everybody. But then there's also pro content that comes out at least once a week, twice a week if things are heating up. Which they were today. And before we get to that Hershey Financial video, let's go over the charts real quick as well. So Bitcoin is moving up here, 116.5, kind of just really shot up over the last couple hours. And I did share this morning. We have crossed through the CME gap that we've been talking about here on the show. The CME gap, is a Schelling point that is a point of focus. So it becomes kind of a self-fulfilling prophecy if everybody's worried about that. Another thing, let me bring up another chart here. The Bitcoin heat map. When this populates, I will share the tab. Okay. I'm going to go to symbol. And let's go to like 1 month. So there's a lot of liquidity above the price as well. So passing through that CME gap, now we can start eating through some of this liquidity. Let's see if is my head too big? Let me try to change that real quick. All right. So you can see that there's a bunch of liquidity above the price all the way up to 120. And I think it's going to want to go there. We do have some bright yellow. These degen longs, man, I can't get over this. Every time we start moving higher, people just come in and go degen long and get, have a liquidation price just barely below where the market is. And so then the market turns around, grabs that liquidity, and, it's just kind of frustrating. The market doesn't want to let you guys have a free lunch. It doesn't want to let these 100x leverage traders get a free lunch. So they are going to liquidate people. And actually, sorry, Telegram, I'll share the screen better. There. All right. So that is what's going on with the price. There have been some big moves here lately. Let me find gold. Gold still going up, trying to push through that next higher level that it's found itself. I drew this arrow the other day because it does need to back test this breakout. When that happens, I don't know. We can just move this out here a little bit, but it should come back and back test that. Stocks, really, they were ripping yesterday. Today, they're a little bit more tame, but this is the S&P 500. Up slightly on the day, but yesterday was a big day, almost a full % yesterday. So my macro thesis is really pretty much playing out. Let's go to the US 10-year, and we'll go to a line because it looks better with a line. You can see that's dipping. I did write about this yesterday. Let me go to that post. Share screen. Okay, so this is the post I came out with yesterday, and I think I have a really good chart on here. Let's see. Yeah, this one. Okay, so you can see I have the 10-year, the 3-month, the 5-year, and 2-year on this. So a good sampling of the curve. And the short end is falling out. It's falling out of the Fed funds range, which it's not supposed to be doing. And everything else is kind of curling over. And, we see that, excuse me, we see that over here last year at this exact same time. Really, it's a replay of last year so far. We will see how far this goes. We do have the Fed funds or the FOMC meeting next Wednesday. The decision will be coming out. And will it be 25 basis points or 50 basis points? If you look at the Bitcoin chart now, if you go back here and you look at the Bitcoin chart and you look at last September, where are we at? Yeah, right here, this arrow. So last September, when the Fed started cutting rates, what happened to Bitcoin? It really rocketed. It rocketed almost 100%. So will we see that now if they do a replay, 50 basis points, then a couple 25 basis points by the end of the year? Will Bitcoin replay that, and have another push higher? I think so. I think it's very likely if the Fed does cut, even if they cut 25 basis points, I think that's going to put a lot of pressure under the price of Bitcoin to go higher. All right, let's get into this Hershey Financial. Let me check the comments, see if anybody's rolling through here. Dex Invictus back with us. Dex, didn't you join the Telegram? I thought you had said that last time. Yeah, make sure you join us over there on Telegram. I do go live more regularly over there, and it's a community where we chat all day long. All right, and then check these comments if there's anything else. No. All right. Share this tab instead. Hershey Financial. Check out the original video. I think he just put it out 6 hours ago. Again, share it on the Telegram, so I'm going to react to it. Let's go. And it's muted.
You're looking at assets or goods, real estate or stocks, crypto or gold. It looks like everything is a bubble. But if everything is in a bubble, maybe nothing is. Maybe the real problem is in your measuring stick. Maybe the real problem lies with your denominator, your currency, the dollar. The price of
course, Bitcoiners have been saying this forever. Gold bugs have been saying this forever. I'm not sure how friendly he is to Bitcoin. In this video, he's, friendly to Bitcoin. But I wouldn't say he's a Bitcoiner. He's more of a gold bug, I would say. Yeah, I mean, there's something wrong with the measuring stick. We all know that the dollar is inflating to some degree, right? But how much is it inflating? And what are the other factors besides money printing? But okay, let's go.
Gold has recently broken out from a multi-month consolidation pattern and is currently at all-time highs, trading for $3,629 per ounce.
Okay, let's go real quick to the gold price. Again, I just want to measure the move. Well, we can just do year to date, and we can change this to percent. And so year to date, it's up 38%. I mean, that's a pretty big move. That's pretty big, I'd say. All right, share tab.
Silver as well is hitting prices that it has only seen a few times in history at over $41 per ounce.
Silver is much less, it's a much worse or much less good argument here because it's not really a monetary metal anymore. It's more of an industrial metal. So it should pump. I mean, it should be more in tune with copper than it is with gold. Kind of a mix between the two.
Bitcoin as well is near its all-time high, trading at $112,000. The S&P 500 is at just under 6,500, and within the last couple of trading days has been playing with all-time highs. The Nasdaq is over 23,000, touching all-time highs as well. The Dow Jones Industrial Average at 45,000. The Russell 2000, which is small caps, is also trading near all-time highs, only being this high a couple of times in the last few years. And the United States Case-Shiller Home Price Index is also at all-time highs. So we have hard assets like gold and silver. We have crypto like Bitcoin. We have the stock market, whether you're looking at high growth tech stocks, mega caps, or small caps, everything touching all-time highs.
Okay, I'll add here that he's looking at things that are highly affected by asset price inflation. And asset price inflation is a thing. Even though I'm more of a deflationist, I think that asset price inflation does occur. It occurs when the market deteriorates and you don't have other places to put your money, right? So instead of starting a business, instead of maybe upgrading your vehicle before you necessarily have to. Instead of doing that, you're going to put it into savings. You're going to put it into S&P 500. That also goes into real estate and things like that. So the asset price inflation is mostly what he's talking about here. The one difference, I will agree, is gold and Bitcoin. Gold and Bitcoin, they symbolize a rising danger in the system, but not a rising danger of hyperinflation, because the way that hyperinflation is just pretty much impossible unless we get actual money printing from the government. So money printing now is done in the process of making a loan, which he does say later in the video here. So he agrees with that. Money printing does not occur when the government spends money, because they take it out of the economy first and then they spend it. The Fed doing QE is not money printing either. It's an asset swap. So unless the government prints money outright, we will not have hyperinflation, period. I can't stress that enough. We cannot have hyperinflation unless the government outright starts printing money, which they do not do. And I don't even know. I mean, I guess they could do it legally under the Constitution, but that's not the way the system works currently. If you go back and look at all of the hyperinflation cases of hyperinflation, that's exactly what they do. They print money directly from the government. They don't borrow money to spend it. They print it. So you can have hyperinflation, but your government debt is going to be very, very low. Okay. If we went through a high inflation period, high amount of government spending, and that pushed prices higher because it pulls forward demand. So it takes that demand from savings from the future, because savings is going to be spent in the future, right? It's taking that value to the future. If you take that value from the future and you spend it today, it does add to demand relative to supply, and prices will rise. But it's technically not increasing the money supply, because that money was already created in the economy. It was just in another form, in another place, not bidding assets higher, right? So if in today's system, to have massive amounts of government spending, you would have to have massive amounts of government borrowing. I mean, it did explode under COVID, and it exploded under Great Financial Crisis. It exploded under, the war on terror and everything. It always goes up. Every presidency seems to go up more than the last, but it's not like it's. What I'm trying to say is, if you wanted to get hyperinflation, they would have to borrow hundreds of trillions of dollars and then spend it, which I don't even think that's possible, right? Because there's not hundreds of trillions of dollars just in savings waiting to go and bid for these treasuries. So there is a limit. There is a limit to how much they can spend, and that puts a cap on the ability to have hyperinflation, the ability to have high inflation, sustained high inflation. We do not have the ability to have sustained high inflation. Now, if you're talking 2% versus 3%, okay, I can go with you on that. But I don't think we have the ability to keep a 10% inflation rate. I don't think that's viable. We didn't even hit 10%, and look how much we quote unquote spent or borrowed and spent during COVID. I mean, we'd have to do 10 times more than that to get it up to 25%, so it is inflating. It is inflating, but the risk is not inflating to the or going to hyperinflation. The risk is going into hyperdeflation. And when do you go into hyperdeflation? When people start defaulting. That's the overall systemic risk, is hyperdeflation. And people say, oh, that deflation is good. Well, they're talking about prices, gently falling prices over decades, right? Yeah, that's good. I mean, that you're in a healthy economy. It's not a policy goal. It's just the result of a healthy economy. But hyperdeflation is really, really bad. Really, really bad. Businesses go out of business. People lose their jobs. People die. Society can fall apart. So hyperdeflation is not a good result. And that is the overriding pressure on this system, is to hyperdeflate, not to hyperinflate. Okay, let's continue.
even real estate, whether you want to look at the US Case-Shiller Index, or even if you prefer looking simply at the median sale price of houses sold in the United States, which is only down slightly off of its high from 2022. Either way, assets across the board are
also, when you're looking at a linear scale, so going back to here, if you look at a linear scale, everything's going to look like it's going parabolic, right? It's better to look at it with a logarithmic, because 2%, if you're looking at a 50-year chart and everything has a 2% increase, it's going to look like it's going parabolic, but it's still just 2%, right? Or house prices say 5%. Its averages 5% a year, but that's going to look parabolic unless you go on a log chart. So it's kind of a trick here, because this on the right, the average here is probably the same as the average back here, but it just doesn't, it looks bigger because you're doing 2% of a bigger number. Okay.
2022. Either way, assets across the board are all at or near all-time highs. But guess what? It's not even just assets, because if you look at the cost of rent across the United States, also at all-time highs, or if you look at the cost of ground beef, it is also at all-time highs.
Yeah, you guys know my argument for ground beef. It has cycles. It has its own internal cycles, and we're just in a really bad time right now. The herds were really affected over the last few years. And so I heard something, or I read something, that the herd size in the United States at the start of this year was the lowest it has been since 1950. And that's like, how many more people do we have eating beef today? A lot. So this doesn't necessarily have to be a part of inflation. This can be that the supply is just extremely restricted. Now, herds can recover, obviously, but that's going to take a while. I don't know how often can they have a calf every year? I don't know if they do that, but so it would take a while to get this back up. We're talking 3, 4, 5 years maybe to get herds back up to good numbers, and then that's just hoping everything goes perfect, right? It could be 10 years before the herd recovers. So yeah, beef is not a good example in my opinion, but I do like that he's going into commodities here.
Or if you look at the average price of electricity per kilowatt hour in the United States.
This also can be affected by regulation. It can be affected by stupidly adding like renewables or wind or solar to the grid, and then there's increased costs overall for the grid. So yeah, this is also could have problems, but the general trend is higher. And I will admit that the general trend for quote unquote inflation is higher, 2 to 3% a year, maybe 1 to 3%, we could say. That's true. That's going to happen. Then on top of that, you add in all these regulations and differences between 1980 and now. We'll explain a lot of these cost differences.
Look at that. It's also at an all-time high. Or if you look at the cost of college tuition, whether you're looking at public or private, in-state, out-of-state, everything is at all-time high.
Well, yeah. Okay. So this one is, I feel like I'm explaining away all these things, which I am. But this one is, of course, because it's subsidized. It's subsidized by the government, and they've expanded a lot of the roles in universities, wasting a lot of money. Similar to, if you look at I don't know, haven't seen this maybe for universities specifically, but I'm thinking of hospitals, and you look at a chart of how many doctors there are in hospitals, how much they have changed or gained versus how much the administration has grown. And the administration is growing like 5 times faster than the number of doctors that work in hospitals. And so probably something similar here with universities. The costs that they have are ballooning because they waste money and they're subsidized. So not necessarily inflation, but again, we should expect a gentle rise of 2%.
Highs. Or if you look at the cost of health insurance, it is also at all-time highs. Whether you're looking
that, I would just say it's a broken market. I don't understand how health insurance is so broken.
at the cost of rent, the cost of food, the cost of your utilities, the cost of traditional education, or even your healthcare. Prices are higher now than they've ever been. So it's not.
I agree, but you can say that every single year. Because if you go back and look at those charts, so here's this one. You can pretty much say that at any point along this chart that it's the highest that it's ever been. And that's because it is. It's going up every year. That's true.
Your healthcare. Prices are higher now than they've ever been. So it's not just assets, it is the cost of life in general that is all going up, and nothing has ever been this expensive. Historically, when there is a bubble, it is an outlier. When you looked at the dot-com bubble, and within the course of just a few years, the value of the NASDAQ went from 1,000 all the way up to almost 5,000. You could tell that that was crazy because other assets not exposed to that sector, like if you looked at the Dow Jones Industrial Average, did not have the exact same thing occur. In fact, almost nothing like it occurred. The Dow continued to move basically sideways during that time, while the NASDAQ had its big bubble and then popped. Similarly, when the big crypto bubble happened in 2017, and Bitcoin went from just a couple of thousand all the way up to almost 20,000 within the course of about a year, you were able to tell that it was a bubble because it wasn't happening everywhere. If you compare it to this price of SPY, you can see the overall stock market barely moved relative to what.
Look at all those idiots in the stock market. They missed out on all those gains, baby.
What Bitcoin did. The point is, the question that you should always be asking yourself when you are trying to figure out if something is expensive is compared to what? And if Bitcoin and gold and silver and real estate and big stocks and tech stocks and industrial stocks and real estate and rent and beef and coffee, and electricity, and education, and healthcare are all the most expensive.
Okay, he did a lot of ands, but he didn't cover the whole economy. I mean, he covered mostly what's asset price inflation explains. There's a ton of other things in the economy that he did not cover. And of course, you can't cover it. He's doing just a video. He's got to pick 10 things. But he can say it in a way to make it seem like he's covering 90% of the economy when he's only covering 9%, right? Or something like that. But yeah, the reason why these markets are going up like this, I mean, there's a lot of reasons behind it, and I cover it in a lot of my other content. I don't really want to go down the whole list of what my macro thesis is, but we can explain a lot of this by passive investing. The growth of passive investing is insane. So if you're looking at stock markets like he did, he looked at all these different stock markets. People can buy index funds. Okay, I want to buy the S&P 500. Well, if I'm doing the S&P 500, I want to do some Russell too. I mean, I just went through this with an inherited account that we got several years back. I just wanted to look at what was in there, and it's just diversified, right? It has some Russell, has some S&P 500, but it's mainly index funds or mutual funds. A broad mutual fund, right? And so that's how people are investing. And so that explains why all of this money goes into all of these different markets like that. Also, like I said a little bit earlier, as the economy is deteriorating, people are not spending, they're plussing up their savings. And the way people save today is through their retirement funds or through the stock market or Bitcoin. Hopefully this Bitcoin is their vehicle of choice, and I do think Bitcoin is in the conversation for sure, but that explains the stocks, why the stock markets are going up together. Okay.
Expensive they have ever been. Then when you say compared to what, you can't compare them to each other because they all look like they're in a bubble. The thing you're comparing them all to there is the dollar. Now,
okay, let's take a look at one here that I don't think is agreeing with him. Macro, and we'll look at copper because copper is used all over the world. And let's zoom out, see where we're at. I mean, it's higher, but it's not dramatically higher. Okay. And we do have more output every year too. So that's not dramatically higher. We can look at oil as well. Oil here, let me take all the drawings off. Um, Oil is not higher. Look how high it was back in the great financial crisis. It got up to 140 and now it's at 62. So there are things out there that you can point to and say, no, this isn't at all-time highs in everything. Like what would you say the most traded commodity in the world? He did not mention oil. He did not mention oil, and it's by far the most important commodity in the world. That should be on his list of everything that's going up, but it's not. Okay. So boom, there you go. Let's get back to it.
And you might be thinking, well, if you pull up a chart of the dollar, it really hasn't done much. In fact, it's at the exact same level it was back in 2015. It's had a little bit of volatility, but it's not falling through the floor like you might expect given the price of everything. The reason for this is because, again,
Dex, you say Hershey's a grifter. Yeah, I think he's kind of a salesman, right? Trying to push your buttons and get you to watch his video and have a rage reaction to it or agree. I mean, there's a lot of people that do content that just feeds on, like you're saying, he's a grifter, feeds on your expectations, but you want to watch somebody diss on the market, and you want to watch somebody say it's doom and gloom out there. So one thing, he was just showing us a chart and I wanted to look at it. Okay, let's go look at the dollar. Where am I at here? Okay. So here's what he's showing DXY. And yeah, it hasn't done much. But look, if we zoom out, okay, let's zoom out. Remember, back here at the peak, do I have this labeled? Yeah. Back here at the peak, that was the Plaza Accord. That's when the dollar was blowing out, getting strong, and wrecking the entire global economy. The dollar wrecking ball just came out of nowhere and was appreciating relative to other currencies so quickly. They got together at the Plaza Hotel and decided we need to devalue the dollar. And that's what they did. They ended up working together to devalue the dollar. Then when we get over here, QE era, let's see if I have it. Got all sorts of stuff on the chart. I want to get the exact right time for QE to get started. I know I have it somewhere. Okay, here we go. I think this is it. Let me bring these up. Okay. So QE was right at the bottom. You would think that QE would weaken the dollar, right? But QE happened towards the bottom here, and then the dollar has gone up since. So that doesn't fit with the whole dissing on, QE is money printing and all this, that whole thing. That marked the bottom of QE. But okay, let's go back to the video. Oh, one more. I wanted to show something else. So also we can take a look at things like this is the trade weighted dollar. And this is against, I think, like 300 currencies or something. If there's a long tail of currencies that this is weighted against. No, it couldn't be 300 because there's probably only 180 or so currencies, but maybe it's 100 currencies this is weighted against, something like that. And it's important because it includes the Chinese yuan and the Mexican peso, things that are not included in the DXY. So as you can see, this has been going up as well. This is going up. Recently, we've had this break. I mean, we could draw a line in here, something like this. And I mean, that's pretty normal, I would say. Looking like we could be bottoming out and we're going on the next wave higher. You could also look at the dollar here. This is emerging markets. So dollar against emerging markets. And it's going up as well. So there's different ways to look at the dollar. When he's looking at the dollar just as the DXY, of course, it's going to be a little bit limiting. So let's go back to here. Let's hear what he says about this again with all that other context. Yeah, it's rising. Like we looked at the trade weighted and the emerging market dollar. Overall, we're in a rising trend for the dollar. It's going to be noisy. It's going to be a random walk. And these periods, the way these periods form is these big steep rises that we see, they cause a ton of economic pain around the world. And that's one reason why these BRICS countries and others say that the dollar doesn't work, because guess what? It doesn't work well for them. And they know that. We know that. Everybody knows that. But it's like, I really hate drinking water, but you got to drink water to live. Okay. You really might hate the dollar. It's not working well for you. It's causing you these periodic pain, with the dollar wrecking ball, but you got to use it. You just have to use it. And then what happens is the dollar slows down. They have a bunch of defaults around the world. There's bailouts. There's all these other things. And the dollar will trend in a sideways fashion in a range, and people will lever back up again. So these emerging markets, the globe, will lever back up on the dollar. And then the dollar, because remember, the risk is deflation, not inflation. And as these deflationary periods spike, what happens is people get squeezed, and that deflation is where all the damage happens. Okay. And then it'll be range bound again until the next time they lever up and it squeezes them again. So that's what's happening here. I think we were a little bit further. We're about right here. Oh, I'm sure in the wrong tab. Sorry, guys. My bad.
Their own currency at around approximately the same rate. Of course, you're not going to have that large of fluctuations in the value of one currency compared to another, which is why the DXY doesn't look anything crazy. Ludwig von Mises was one of the fathers of Austrian economics.
Well, we just disproved him by looking at the trade weighted dollar and the emerging market dollar index that the dollar is going up. And it has the same general trend in DXY. It's just a little bit slower because those are larger currencies, but the trend is higher.
And he described something called a crack up boom. He said, if once public opinion is convinced that the increase in the quantity of money will continue and never come to an end, and that consequently the prices of all commodities and services will not cease to rise, everybody becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. For under these circumstances, the regular costs incurred by holding cash are increased by the losses caused by the progressive fall in purchasing power. The advantages of holding cash must be paid for by sacrifices which are deemed unreasonably burdensome. This phenomenon was, in the great European inflations of the 20s, called flight into real goods, or
I thought this is interesting. So he's talking about public opinion. It's been a long time since I've read my Mises, but the emphasis on public opinion is interesting. So, a lot of the modern bankers, the way they think that inflation works is expectations. So if people expect there to be inflation, then it's kind of like a self-fulfilling prophecy. They'll act in a way that will actually manifest that inflation. And I thought that, like I said, it's been so long since I've read these Austrian guys. I find it interesting that he has right in here, if once public opinion is convinced. So that's the same sort of idea as these neoclassical, neo-Keynesians. Will continue to never come to an end, that consequently the prices of all commodities and services will not cease to rise. Well, we just looked at oil. the most heavily traded commodity in the world, oil, is not agreeing with this crack up boom theory.
Crack up boom. In other words, any rational person will choose to get rid of dollars as fast and as soon as possible if they know the purchasing power of those dollars is going to continue declining. People will buy anything and everything they can because at least they're preserving their purchasing power better than if they hold on to those dollars.
I mean, that's true. Another thing is a lot of people are expecting there to be a big crash in real estate prices. I think there probably will be. I don't know exactly when that will happen, but it'll probably go. The prices will tend down before they tend back up. 1 second, guys. All right. Yeah, so I think prices will trend down before they trend back up with real estate. And what is that? That is your dollar appreciating relative to real estate. That's the dollar appreciating. That's not an inflationary move. It's a deflationary force, right? Because the dollar is buying more. It's the same if we go into recession and the stock market crashes, your dollar is going a lot further because now you can buy more shares than you could before. So that's a deflationary. It's not deflation, but it's deflationary. So appreciation of your currency is deflationary. What did I say? Did I say that right? Appreciation is deflationary. Depreciation is inflationary. But we need to talk about the elephant in the room, and that is, how do we count the money? If we want to talk really about inflation and deflation, we got to talk about, how do you count the money? Why doesn't the Federal Reserve, why do they use the PCE? Why do they use prices to measure inflation instead of actually using the money to measure inflation? Well, people say you can use M2. Okay, well, that's what Hershey's about to do. He's about to use M2. But the reason why they dropped that, the reason why they came out with M3 way back in the day, I don't know when M3 started, but probably in the 90s or so. Let me Google that real quick. No. Not M3 chip. I want monetary M3. They began publishing the data in 59. Okay, that's a lot further back than I thought. But why did they have to start using M3? Well, first they had M1, right? Then they had M2, and then they had M3. Why did they do that? Because those measures of supply did not map onto what the economy and prices were doing. So they got rid of M3. Now they don't even use M2 to count money anymore because they realize that that does not match what's going on in the broader economy. So let's see what Hershey says about M2.
We are not experiencing anything closely related to what could be called hyperinflation. This is the phenomenon that we are seeing happen in America today. Those who have the means to do so are buying assets to protect their money. And those who do not have the means to do so are dealing with the consequences of that inflation by buying goods, in other words, the cost of living, at the higher and higher prices. Now, at this point, you may be wondering,
that's true.
Is there any way that we can tell that this is actually going on? Maybe there is a bubble happening everywhere. Is there another form of measurement we can use to look at the price of these things to see if they are only expensive in dollars or if they are expensive compared to other things as well? And for this, I would like to show you the price of things priced in gold for a couple of reasons. Number one, when you look back over hundreds or even thousands of years of human history, the purchasing power of 1 ounce of gold stays relatively stable throughout time. Whether you look at the salary of army captains, whether you look at the cost of a haircut, or the price of a custom 3-piece suit, when you price things in.
Yeah, I remember my dad telling me this long time ago. And I mean, I got into economics through my dad's love of economics, and he would always tell me that, the price of a good suit has always been the same when you price it in gold throughout history, stuff like that. And that's true, but not on a decade, even a decade to decade basis. That doesn't hold true, right? You have to actually go back and look at like 100-year moving average or something like that on gold. And so anyways,
In
let's see what he says.
gold, it costs the same amount roughly throughout time. In other words, the amount of stuff you can buy with 1 ounce of gold stays about the same, regardless of where you look in history or when you look in history. It is a much more stable measuring stick in order to look at prices. And so when you see something at all-time highs priced in gold, then that is a good indication that it might be expensive. Not a guarantee, but a good indication that it might be. Now, if you take a look at these things priced in Bitcoin, which many people would prefer to do, the only thing you're going to see is that prices are collapsing because the price of Bitcoin has gone up so much, so dramatically over such a short period of time. It is not very useful for looking at a historical measure of prices when you denominate something in Bitcoin.
That's true. But make sure, here, Hershey, make sure you put on the screen gold priced in Bitcoin, or is that the right ratio? Yeah, the Bitcoin to gold ratio. That's an important thing to make sure your viewers
Okay,
see.
so right here you are looking at a chart of the S&P 500, except instead of being priced in dollars, it's priced in gold. Now you may be looking at this and thinking, okay, going back to before the year 1900, the value of the S&P 500 compared to the value of gold is elevated, but you're certainly not going to look at this and think, oh my gosh, this isn't a crazy bubble. Obviously, something like the dot-com bubble was absolutely ridiculous. And obviously something like the early 90s, stocks were extremely cheap, but at a ratio of 1.79, while maybe historically elevated, it is certainly closer to a more normal average ratio. We don't see stocks priced in gold being in a bubble or necessarily cheap. This is a chart of the NASDAQ priced in gold.
Oh no, I'd say it looks like a little bit of a bubble, wouldn't you? I know the what he's trying to say, but I mean, compare where we are here on the right to this bubble in the late 60s. It is a bubble. Take this one out. This is a bubble. So if we go to here to the NASDAQ, same thing. I mean, yeah, take this big bubble out, and it's the biggest bubble. It looks like it's in a bubble to me.
As far in history as the S&P 500, we get a similar end of the chart here. This is a chart of the Dow Jones Industrial Average priced in gold, which looks
same thing. It looks like a bubble. He says it doesn't.
even more fairly valued. Definitely nowhere near bubble territory. Arguably not even expensive looking. This is a chart of the Russell 2000 priced in gold. Again, this only goes back to 1987, but this actually might look cheap. You can even look at charts from pricedingold.com to find prices of things like college tuition at Yale priced in gold. You can see not only is it nowhere near all-time highs, it's actually a lot closer to all-time lows. They have a chart
That's a good one.
of electric power in the US, although it does end in 2021. So there's a good chance that electricity prices priced in gold are more expensive now than they were a couple of years ago. But again, not close to all-time highs. You can
I mean, all of these prices he's cherry picking here have market dynamics all their own. Like, you guys know the market dynamics around tuition, the market dynamics around electricity costs. And yeah, there is a tendency to have 2 to 3% inflation every year, but there's also a tendency to have 2 to 3% increase in regulation every year, right? And regulation impose costs on those industries. So break it out. I mean, again, he's not going to use oil as an
And even
example.
look at the price of the median home sale in the US since 1965, priced in both US dollars, which is the green line, or priced in gold, which is the red one. And see again, not only is this not near all-time highs, it's much closer to an all-time low. Now earlier I showed you a chart of the dollar versus other currencies, and that did not give you a good indication of what the value of the dollar had done or will do in the future. So the question is, if the US dollar is losing purchasing power versus goods and assets, is there any reliable way to anticipate whether that will continue into the future? One lagging indicator you can look at is the M2 money supply.
I would say the way you forecast it in the future is understanding how the system works. Okay. Yeah, you can forecast that the dollar is actually going to strengthen against other currencies because that's the way the system is set up. That's the dynamics behind it. The problem with looking at, I mean, there's so many problems.
This is simply a chart put out by the Federal Reserve that shows the total supply of US dollars in the US financial system. Obviously, this chart usually goes up and to the right. After all the money printing that happened in 2020 and 2021, the growth took a brief hiatus and the money supply actually declined for a short period of time. But it has begun climbing yet again. And if we zoom in on just the last few years, you can see that the money supply is now at a new all-time high, eclipsing the high that it hit in 2022. You can also take a look at this in terms of the growth rate. So this chart compares the money supply right now compared to where it was 1 year previous. You can see that typically the growth rate of the US money supply is between 5 to 10.
See, what I would do is I would take this chart and then I would superimpose the change in electricity prices or whatever else he's looking at. You can add more things to this chart. I don't know if Fred has like electricity prices or not, but if you added on here the change of price of all of the things he's talking about, it would not match. So that's why people don't use M2 as a way to count money, because it doesn't match. It's non-predictive.
10% per year. It peaked in 2021 at 27% year-over-year growth, and it bottomed in 2023 at a decline of 4.87%. And it bottomed in 2023 with a negative 4.87%.
Just look how high that got, 25% growth, and we had 9% on the CPI. Imagine what it would take to get to 20%. Crazy. And just to kind of explain this a little bit more, M2 is like visible money, but there's a lot of invisible money in the shadow banking system. There's a lot of invisible money that's just being transferred every day. Trillions and trillions and trillions of dollars are flowing around the shadow banking system, and it's a lot of it's rehypothecated value. Okay, so there's chains of collateral, and those chains of collateral can be 6, 7, 8, 9, 10 different hops, and each person along that hop considers that they own that collateral. Okay, and the same is going on the other side. There's money being created and destroyed on the other side, transferring between these banks. So that's where most of the money is. Most of the money is in the shadow banking system that we cannot see. Now, when there's a crisis and there's a bailout, what happens is those chains get shorter. So that effectively shrinks the money supply in the shadow banking system. And they increase the money supply, M2 here. It kind of draws this high-powered money out of the shadows and onto the M2. So M2 going up is actually a sign of deteriorating deflation going on in the shadow banking system. It's not straight up money printing. Hope that makes sense. You guys can ask a question for me to explain.
Now the growth rate of the US money supply is back into its normal range of 5 to 10% and probably headed higher, especially considering that the Federal Reserve is largely expected to begin cutting rates very soon, given the
Okay, this part's all wrong. We'll watch it in just a second. But going back to this chart, also this negative part right here is very problematic. If you think about credit, okay, so as an individual, you say you have a bunch of credit card debt or something, and you're able to make ends meet. but then there's some emergency or something, and now you can't meet that credit card debt payment. So you're going to start tightening your belt elsewhere. You might not go to the movies, or you might not go out to eat for your birthday, or whatever the case is, right? So stuff starts being cut back on. And that pressure, now think about that pressure as an economy-wide pressure, a shadow bank pressure, that you had to start cutting back in places. And what happens? People start getting defensive. Banks start getting defensive. Banks stop lending so much. And the economy slows down. So this is not like, if you just look at this chart, you think, okay, we're going to count M2, and that will tell us everything we need to know. No, this is a sign that bad things are happening, and that those bad things can compound on each other over time. So just because this is back positive now, that doesn't mean that pressure is relieved. The economy is much more dynamic than moment by moment M2. These are long-term things that build up and carry over quarter to quarter, year to year. They have a lot to do with relationships. So relationships between bankers, relationships between large money allocators and bankers. All of that matters and builds up over time until somebody is caught. The music stops, everyone's got to grab a chair, and there's not enough chairs for everybody. So this dip in M2 tells us that they took a chair out. That's a good analogy of the musical chairs. That's what this means. The music hasn't stopped playing yet. People haven't rushed to sit down yet, but somebody took a chair out. Okay. And everybody knows it. All the high-powered money knows it. They know someone took a chair. And so what? They're eyeballing it. They're trying to, how when you play musical chairs, you try to spend as much time in front of the chair as you can. And then you go real fast to the other front of the other chair. You slow down. And then, so bankers are starting to act defensively because they know someone has taken the chair out. And that's what, if we go back to the yields, share this screen. If we go back to the yields, which one was it? Which list am I looking for? Right here. This move in short-term yields says that people think the music's about to, stop, and everyone's starting to run for those chairs. And what are the chairs in this case? They're U.S. Treasuries. Okay, that's a protective, safe asset class. And just for you guys that might not have seen this chart, I'll bring up this Fed funds policy. So it's dipping down below the Fed funds policy, just like it did here. Everyone's starting to run for those chairs. So that's what I would say on this one. Okay, let's go back to the video.
Growth rate of the U.S. money supply is back into its normal range of 5 to 10% and probably headed higher, especially considering that the Federal Reserve is largely expected to begin cutting rates very soon. Given the fact that dollars are loaned into existence, that means lower interest rates are pressure on fueling the growth of the money supply. Lower interest rates are a signal to economic actors to borrow and spend because money is cheap, it's easy, and it's abundant.
Completely wrong. That's completely backwards. No, low interest rates are a result of what's going on in the economy. They're not a signal to go out there and borrow. You might want to, as an individual, you might think, okay, I need this purchase, but I need to borrow money. Maybe it's a house, okay? And I'm going to wait until interest rates come down, then I'm going to go buy a house. Yes, I can see that. That is true, but that's part of asset price inflation, okay? And asset price inflation is a narrowing of the water hose. So instead of credit going out everywhere into the economy, it's being narrowed into specific assets. They have to continue with the printing through making a loan. They have to continue with that because if they stop that, then people can't service their debts. It's the old goldsmith's tale. If if I make a loan, so let's say the economy is one bank and one customer, okay, and that bank makes a loan for $100, but there's a 5% interest rate on it. There's not enough dollars in the economy to pay off the debt. There's only $100 out there because that's what was created in the loan. So where does the money come from to pay that extra $5 back? It has to come from the next guy, and then the next guy. The net credit creation has to be at or maybe slightly above the inflation rate. Or sorry, the net credit creation, which is the inflation rate, has to be slightly above the interest rate. So you have to continue, because people are repaying debts all the time. So they're retiring old debts and they're taking out new debts. And the net of that has to be positive. It cannot be negative, or we start getting defaults. All right. So why interest rates going down? He says that it's positive for money creation. It is not. It actually means money is tight because people don't want to lend. You might want to go buy that house, but that is asset price inflation because it's narrowing of the hose. But for everybody else, it's tight. Everybody else, it's tight. You might not be able to get a business loan or personal loan or whatever because they're narrowing the credit worthiness standards, their borrower standards. And I don't know how else to put it. People are going into those assets for safety because money is tight. They're worried about default. They're worried about making their payments. So they're going to cut back everything else. They're going to put everything else into savings that they can. And that forces interest rates down. So interest rates falling naturally. I just showed you the chart of the 3-month. Interest rates are moving. The Fed hasn't cut rates. The interest rates are moving before the Fed cuts rates. What does that tell you? That tells you that nothing that the Fed does mechanically moves. It's not like they're out there right now mechanically at their open market operations that they're out there trying to push the 3-month lower. No, the 3-month is going lower naturally. Then they come in and they match that. So wherever the 3-month is on Wednesday, that's going to be where the middle of the channel lands. So if it keeps dropping Monday, Tuesday, it's dropping hard or something like that, look for a 50 basis point cut. That's my call. The main call is that it'll be wherever the 3-month is at. But I think it's likely that the 3-month continues to drop next week going into the FOMC decision, and they end up cutting 50 basis points. So, yeah, let's listen to the last couple minutes.
Which means if you are expecting everything to crash in terms of dollars, you would need a massive departure from what has been taking place with the US money supply for decades. You would need to expect that the US government was suddenly just going to stop borrowing and spending money. You would need to expect that policymakers would be okay with and would allow a deflationary death spiral that would rival or perhaps exceed the Great Depression to just happen again. And while I guess that's technically possible, I don't think that it's anywhere near the most likely outcome, which means I don't think we are in the midst of a bubble getting ready to pop. I think we are just seeing the gradual but consistent decline in purchasing power of the dollar across the board. And if you want to protect yourself from that, you have to be invested in those assets. You have to be diversified across asset classes, not just stocks, not just real estate, not just Bitcoin. If you
heresy. It's Heresy Financial, not Hershey Financial. Yeah, I agree with that, man. I in the end here, I'm agreeing with him that they can kick the can. Okay, they can kick the can, but what does that says something about the future too. If you don't allow for creative destruction and you kick the can and you bail out and you move on, the economy will eventually reflate, but it will reflate less than before. Growth will be lower than before because you have all of these old malinvestments locked in. You didn't allow for creative destruction. So you have these old inefficiencies locked into the market, and the next time around, the reflation will be lower. So you get lower growth, lower inflation, and you are at about the bottom limit. 1 to 3% is about the bottom limit for quote unquote inflation to be. So you're just going to drag along at 0 to 3%, whatever, forever. And it's going to feel like a recession. It's going to feel like a depression. I think we've been in a depression that has been developing over the last 15 years, pretty much since the great financial crisis. So how long is that? 16, 17 years. We've been in a depression that has been slowly manifesting itself because of all these bailouts and because of the financial engineering around in the financial system. It's slowing growth and slowing inflation around the world, increasing fragility. And what happens when something does break, when that fragility it becomes obvious and actually breaks? Deflationary impulse. A deflationary impulse. The dollar goes up. Stocks go down. House prices go down. Noticeably. I mean, we could see a 50% drop in the stock market. That's a doubling of the purchasing power of dollars relative to stocks. So that's the overall pressure. But he wrapped it up nicely, and I agree with him. The goal right now is to extend and pretend and hope something happens. Hope AI is actually real. Okay. Hope something happens in the economy to bail out the system and push productivity so high that we can produce our way out, that we can grow our way out. But right now we cannot grow because we have all these inefficiencies locked in from the previous bailouts. The system is old and decrepit, but it can live forever. But it can live forever until we decide to change it. And that's what I think Bitcoin does. Bitcoin is the only real option here. You could go back to gold, but then you're still going to have, gold has it's slow. It has to be in the ground. You're going to have problems with settlement. It also has an inflation rate. Like the inflation rate under the classic gold standard, a lot of people say there was gentle deflation. No, there was not. There were gentle price decreases, but there was a lot of inflation under a classical gold standard. It was higher. So under a classical gold standard, the average inflation was around 3%. That means the average stock of gold, monetary gold, grew by 3% a year. A lot of people don't know that. But under the classical gold standard, the stock of gold, monetary gold, increased by 3% a year on average. That's above the 2% goal of the Fed. But of course, they're targeting different sides of the house. The Fed is targeting prices, and prices did slowly decline under a gold standard. But the actual inflation rate under gold standard was 3%. All right. I think that's enough of that. Let's check market prices here. What's going on with Bitcoin? 116.3, having a really good day. I thought we could make it through that CME gap by the end of the week. And then going into the Fed cutting next week. They almost guaranteed to cut. Let's see. Let's bring up the FedWatch tool from CME. Just wrapping up here, guys. Unless you have any question, comments, put them in the chat. Okay, so I'm sharing that. So we got a 96% chance of 25 basis point cut and a 3% chance of a 50 basis point cut. This has changed a lot in the last couple of days because this was as high. I think it got as high as 15%. Let's see, a week ago. This says 11% a week ago. I think it got as high briefly as 15%. I think that's way underdoing it. Let's go back to the 3-month. Check that out. Even the 2-month is starting to move here too. Look at that. Even the 2-month is falling out. 1 month, it's doing its thing too. Look at that. This is having a nice bounce here. If we go to the daily, one thing I pointed out from last year, if you look at the last year before this cut, 50 basis point cut, it did have this little bump up, and then it continued to fall. And then they cut 50. So now we've had this bump up right at the bottom of that range. So it's settling right here at 4.0%. So that is telling me as well that this is correct. That's what the market is pricing in through Fed funds futures, is a 25 basis point cut. But we will see. Oh, share this tab. That says this is correct. But now going back to this, if we do drop out like next week, it starts going like this over the next 2 days, straight down, which it can. It just did that. Then that's telling you it's going to be 50. So that's what we need to watch going into next week. Okay. Bitcoin. Let me see. John Delaney, what's up? Yeah, it's been a while. I mean, I've been doing my Telegram stuff. Would love to see you guys over there on Telegram. Dex, you said you're not a big Telegram person. Yeah, just check it out. See if you like it. Go back and forth with people in the community all day over there. I'm going to, I try to go live here on YouTube every once in a while. Yeah. Oh, John and Dex, if you don't know, I started doing spaces every morning with BitcoinTreasuries.net. So Pete Rizzo over there asked me to come on and just host their spaces every day and go through and invite guests on and all that. So I've been doing that every morning around 9 a.m. It does differ because of different guests that we have, but doing that every morning, having some great conversations. And then I share the audio as well with Telegram. So that's another bonus of being on Telegram. But check that out. The Twitter handle is BTC Treasuries. Going live there every morning. All right, let me check Telegram, see if they had any comments. Larry Jr. says, Fed chairman will drag his feet and only cut 25 basis points, not to appear to cow to Trump's pressure. That's a good point. I think if he can get away with it, he'll do 25. Yeah. He doesn't really want to cut. I don't think Powell is convinced that inflation is beaten. And it isn't. I mean, we just had the CPI come out this week, and it was, I would consider, somewhat hot, right? It was 0.4%. Let's go to that. That's a good chart to end on, actually. Got to go to regular scale. All right. So for anybody watching that's new, I'm going to put on recessions as well. So anybody that's watching is new. I highlighted this right away during the COVID crisis, and we were starting to see inflation pick up. And I was like, no. We're going to return to post GFC normal. That's my term. I don't think anyone else is even using it, but if anyone else uses it, they got it from me. But anyway, post GFC normal. And what does that entail? Okay. That is what we kind of talked about here. Low rates, you have low inflation and low growth. You're stuck in this because you did not allow for that creative destruction to happen. You locked in inefficiencies, malinvestments by bailouts. And so the economy cannot get going. All right. And when the economy gets going, what happens? People take out a lot of loans. They take out a lot of loans and go long, go long on their business. They go long on different people's businesses. Maybe they think, hey, I got a raise. Things are going great. We're going to take that extra vacation. I'm going to borrow for that vacation or whatever the case. And so there's a lot more lending that happens when the economy starts getting going. What is lending? It's money printing. Okay. So when you have growth in a credit-based economy, this is specific to a credit-based economy. If we back something by gold or back something by Bitcoin, it no longer functions the same way. Then you can look to the Austrian school, but they don't do a good job talking about, even though Mises's book, Money and Credit, okay, the Austrians have forgot that we're in a credit-based world now. We're not in a commodity money world or even a fiat money world. We're in a credit money world. But so inflation and growth are basically synonymous in our system. So when you see a lot of when the economy rebounds, people will take out more loans. That's printing of money. The inflation rate will go up. But since they lock in all of those inefficiencies, the growth rate cannot be maintained. So like right here in COVID, there was a lot of fiscal spending. People had a lot of extra money. The economy kind of boomed, right? So there's going to be more credit expansion, higher inflation, but there's nothing real to back that up. That money is going to run out. They have to come back to reality, and boom, we hit a brick wall. And I was predicting that brick wall the whole time, coming back to post GFC normal, and that is exactly what we've done. And so it bounces a lot. And what we saw this month for CPI, it's back to the top of the range. What's the next thing that's going to happen? Probably come back down to the bottom of the range. And then one thing I posted as well on this is you can see back during the Great Financial Crisis, we actually did have a spike in CPI. It actually went higher while in recession. It wasn't declared at this point. I think it got declared pretty much right after this spike in inflation, but then it crashed through the floor. You declare that recession and people go defensive. Money creation slows way down. Yields drop down to zero, to the floor, and boom, prices contract. That's exactly what happens. And but what I was pointing out was this spike. So we could expect perhaps before we do go into recession this time, we do get a little bit of a spike outside of this GFC normal. So let me get the path. So maybe we see something like this, like a little bit of spike up here, and then boom, comes down. So that would be very similar to what happened over here in a great financial crisis. But overall, this is post GFC normal. Low growth, low inflation for as far as the eye can see. It feels like depression. I think that's the proper analysis here. All right, let me check comments one more time. Hold on a second. Share this tab for now. All right, no more comments. So, all right, guys, thanks for joining me. Ansel Linder, Bitcoin and Markets. Subscribe, like, share. Thank you so much. Have a great weekend. I'll see you on the next one. Bye.